Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the inflation that moves those markets. And as we look into the Fed manipulation of our equities and currency markets, we definitely want to comment on how gold has been responding to the substantial sum of money we're expecting to see flood into the market over the next at least 3 quarters into the beginning to middle part of next year. And then the question, of course, being, what does that end up looking like, and how does that extend, and how does that actually affect the other markets? So before we dive immediately into the charts this week, I think it's worth talking a little bit about what we're looking at over the next 6 months, and how does that compare to the first quantitative easing package about 10 years ago and TARP money. So, Tori, what you got?
Yeah, we get a lot of listener questions about the manipulation issue, right? And the response to the manipulation issue, saying, well, why are you showing charts if the prices are manipulated? Every market is manipulated, okay? What they're doing by expanding the Fed balance sheet again is manipulation. That's absolutely what they're doing. Now, going back to your point on the initial QE, the Federal Reserve does not want to call this quantitative easing, okay? Because they're buying T-bills, essentially to the tune of $60 billion a month, and they've committed to do that through the end of the second quarter of 2020. So now, even though we've exceeded that, to your point, we're over $200 billion, I think, in October, because the first issuance ended up being 4 times the expected amount. But all that being said, they're pumping the system with money. All right, this is the creation of money by the Federal Reserve increasing its balance sheet. They're countering what they just brought to a close in the spring of this year. So in March, they said, okay, we're going to shrink the balance sheet. In fact, we're going to end the balance sheet, and they were doing quantitative tightening. And everybody was upset because it's economically stifling to do so. Well, here we are 6 months later, and they've had a complete reversal. That's a replay of what we saw back in 2009 and 10. So quantitative easing 1 was announced November 25th, 2008. All right, and this is comparable to that one. Let's replay here for a sec. We had a major economic crisis going on at the time, and so they justified this massive quantitative easing. This one is comparable to that, and yet this morning you're reading how this is the healthiest U.S. economy in history.
Well, some people are writing that it's the healthiest U.S. economy in history. Yeah. Or tweeting.
Yeah, I think Eric tweeted that this morning. So sorry, Eric, I got to counter your economic health comments. But no, 3.5% unemployment rate sounds great, right? Well, the way they measure has changed, but 3% economic growth sounds great. We've had better. So whether it's the best U.S. economy ever or not, I'm not sure. But even arguing that it's healthy, why then is this necessary? Why are the repo markets telling us that this is something that's critically necessary? Well, what this also shows me is that there is total uncertainty. Nobody knows. Every time they make a decision, it ends up changing. So back with QE1, they paused that in March of 2010. Okay, they terminated it. I shouldn't say pause, they terminated it. By November, they had already reinitiated QE2, right? So they said it's no longer necessary. So now November of 2010, here comes QE2, and that's going to run all the way into 2012 later on. Okay, and they say, okay, QE2 is now terminated June 12th, 2012. And then suddenly 6 months later, QE3 is initiated. What did we just see again in March? They said, okay, we're going to end the Fed balance sheet growth, and we're going to tighten, and we're going to shrink the balance sheet completely down. And now 6 months later, like clockwork, here we are again, a complete reversal in policy. So yes, that's a way that they're manipulating markets. But we get so many comments about the metals markets being manipulated and that the charts aren't making sense or aren't valuable, Miles. So why don't you speak to that?
Well, the biggest way you see market manipulation, especially in commodities, is in the futures and options market, right? Because of the leverage that you can build into those transactions. So similar to what we saw during the last market crash, when you have a systemic crisis where you have a number of people all trying to get out at the same time, and you're in things like futures and options on a leveraged positions, you have a price built into these leveraged options or futures contracts where the bank's going to call your margin if the price drops to a certain point.
So the key term here, Miles, that I heard you use is leverage, and that's what the futures market represents. So if you can buy one gold futures contract, which is 100 ounces of gold, for 4.5% of the value of that contract. So let's say $1,500 gold right now. One futures contract is worth $150,000. Well, you only have to come up with $6,750, roughly 4.5%, in order to buy a futures contract. So then what happens is if gold goes up, you're making all the profit on all 100 ounces. But if it goes down, you can quickly see how your $6,750 gets swallowed up.
Right.
Okay.
And as soon as that gets to zero, you have your margin call where they just close the position out.
Right. And with silver, it's 5,000 ounce contracts. Okay. And one of the ways that they can manipulate the price, and we saw this in 2013 when I was fishing and you were basically handling the entire office.
Don't remind me.
And that is that they increase the margin requirements. Remember, so 4 times in a row it created this snowball effect where they wanted the silver price to come down aggressively. So they just kept saying, okay, you want to buy a contract? You have to step up to the table with more of your own money. And it got very unattractive very fast because the leverage was losing its attractiveness.
And we saw that fascinating disconnect between the futures and spot price market of silver and physical product because the mints were not letting go of coins. So they were not willing to follow suit, and they were happy to sit on their physical product, and that's when you saw things like Silver American Eagle selling for 30% premiums.
Yeah, so if you're coming to the table with $67,000 in order to buy, obviously 10 futures contracts in gold, that's 1,000 ounces. Now you can see how you can start to move markets with very little money instead of having to actually buy ounce per ounce the face value of that gold in the current market. And then same thing with silver. There are also short sells and naked short sells. I get all that. So our listeners who are screaming about manipulation, there are tools, but listen, everybody, it's not once been manipulated in this summer or this year below the cost of production in either metal. Okay, the technical analysis that we have provided has absolutely held for entry points and exit points because even futures markets contract holders are following technical analysis.
Right, and I think the argument is for those of us who do scream manipulation, you haven't even seen it yet.
No.
And that's the point. The point is eventually the markets reach that second stage of a market move that we talked about a few weeks ago to where you can actually throw charts out the window. But until that point, we're going to continue to encourage people while the markets are still sane, or at least relatively sane, although with this new not QE program that they're announcing.
Do not call it QE4.
Yeah, don't call it, come up with a different name. I mean, QE was a new name they came up with because they didn't want to call it inflation anymore. So I guess every 10 years we make up a new term. So maybe we'll start casting lots as to what they name the new inflationary term to be.
Yeah, they had to actually define the difference between QE and credit easing. So anyway, let's jump into the technical aspects of the metals if you're ready.
Because they do still work today, and we know that at some point they won't. So looking first at gold and talking about opportunities, I would say we've got one pending. I have no inclination to believe that we're going to get a continuation up over the next couple weeks. I think we are going to see gold hold sideways or possibly even come back down. So if we look at the market move since like the end of August, beginning of September, we did put this top in and built a really nice little head and shoulders pattern there, topping out in the 1560s. Now what's interesting is both the inside shoulders and the outside shoulders, which I'll put here on the chart, are a declining pattern, and we've got some pretty good fib levels both on the medium term between the start of the rise in May as well as the longer term looking back in like November of last year where we started this whole longer move. And so I'm going to put my short-term target at around 14.15 where you've got your long-term 382 and the short-term 50% line both lining up. Now, I like the 50% line because some of the other metals have already hit it. So look for gold to consolidate sideways, but eventually we are going to see the metals probably come back to that 200-day, that 40-week moving average, and then make its continuation from there. So solid D-wave prediction here. We had our A, we had our B, we had our big C. Now it's time to have a D-wave consolidation before we start the next pattern up.
All right, moving into silver. Last week we came down to that 50% line. Looked like we were going to have a reversal there, but we did not reach back above that upper trend line. Looks like we're going to continue to trade sideways, possibly with a little bit more of a correction.
Yeah, that's right, Eric. We're staying within that declining trend line, and until we have a break one direction or the other, the assumption is you remain with the trend. Moving over to platinum, we did have that break below the top-end floor that we talked about, so it wasn't surprising to see it continue down. In fact, we came all the way down to the 786 fib and bounced that pretty aggressively. So we're still sitting in the long-term upwards channel. We actually would have a long way to go for platinum to argue bearish on the long term, just like any of the other metals, gold, silver. Again, weekly show, got to talk about the weekly movements. But platinum has taken the deepest dive of the three metals and should, I would expect, to reverse first when that ends up happening. But for the time being, you need to consolidate here. You need to build a little momentum in the platinum price. And frankly, you need to get back up into the 900s and stay there. So now the reason I think platinum may reverse first is not just because of the depth of the move, but also because of the breadth of the palladium move. So palladium has a breakout to the upside of all directions, which throws all of the charts out the window because it's hard to chart something where you've got no history. So extrapolating out some fibs, I'd say if palladium continues up, your best target is probably about 19 and a quarter for the next move up. So that's quite a ways for those of you keeping an eye on this. But hooray to palladium. I'm kind of getting sick of saying it because I'm still a platinum bug. And all that means is if you haven't jumped on the platinum palladium or platinum to gold ratio, added a little bit of platinum to your portfolio yet, the opportunity is just getting better. And it might even continue to get slightly better here until we see some of the metals readjust their prices, readjust their ratios back to mean.
Before we wrap up the show, I just want to mention one more thing on manipulation. We talked about, how the markets are being manipulated and the action that it takes to do so. But don't forget that the first step in this market manipulation is the media and the news that the media puts out. This new QE program is a big deal and it shows a big crack, but somehow it's not your headline news. The headline news when all of this actually was coming to fruition was that Trump and China had another trade deal, which has at this point, I think, broken down again. So
and the whole Syrian Turkey
exactly. So there will always be, it's a smoke and mirrors game, but you can't just read headlines. That's a big problem. If you just read headlines, that's not what is going on. You have to do your research and you have to dive deep.
We appreciate your comments and do keep them coming on the manipulation. We know that it's frustrating, but again, look at every market. And that'll wrap up this week's show. Thanks for listening.
If you liked what you heard, click the subscribe button, ring the bell, head on over to our website, McIlvaney.com, Twitter, ICA Gold, Facebook, McIlvaney Financial, or you can give us a call anytime to discuss your personal metals portfolio at 1-800-525-9556. Thanks for listening. Have a great week.